It's time for Yahoo Finance's Market Minute. Stocks mostly lower to kick off the month of June, with China adding more fuel to simmering trade tensions, hitting back President Trump's claim that it had violated the tariff agreement. These headlines weighing on sentiment to start the month. Steel stocks, though, are surging as President Trump announced that he's doubling the tariffs on imported steel from 25% to 50%, saying this will strengthen the domestic industry. We're also seeing shares of Cleveland-Cliffs, Steel Dynamics, and Nucor jump on the news. Plus, shares of BioNTech are higher after announcing that Bristol-Myers Squibb will pay the company up to $11 billion to license its next-generation cancer drug. The company will get $1.5 billion up front and $2 billion per installment through 2028. We're also seeing sports betting stocks Flutter and DraftKings falling after Illinois lawmakers put a tax hike on sports betting. This is part of a bill that still has to be signed by the governor. That tax hike would take effect on July 1st. And that's your Yahoo Finance Market Minute.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. One expert discusses how to find unique opportunities that can grow over time, but also hold up during turbulent times. And the federal government is expected to start withholding wages and Social Security benefits this month for defaulted student loan borrowers. We discuss how you might be impacted. Plus, all week on Wealth, we're going to be performing your 6-month financial checkup. We are bringing in experts to discuss how to review your investments, your savings, and credit cards midway through the year. Stay tuned for all that and much more during this hour and throughout the week. But first, we take a look at some of the market action. We're kicking off a fresh trading month, and we're 90 minutes into today's trading session. Stocks mostly lower on the first trading day of the month as global trade tensions escalate. My next guest says while there are short-term challenges facing investors, there's still plenty of areas of opportunity. Joining me now, we've got Christian Magoon, who's the Amplify ETF CEO. Christian, good to have you back here with us. You're looking at areas of the market that blend long-term growth with defensive qualities. Walk us through how you're assessing those.
Hey, Brad, happy June. Good to see you. And yeah, there are some areas in the market that you can take a look at and maybe smooth out the volatility we've had this year. There's been pops and drops. Right now, we're kind of on a pop, even though the market is up a little over 1% for the year. One way to maybe take a look at the U.S. equity market is to do it through the lens of a covered call strategy. And simply that is owning U.S. equities and then writing covered calls on some of the individual names, which helps you harvest option income, which adds to your total return, but also cushions during market volatility. So we have our Devo ETF that looks at large cap, high quality blue chip companies that are dividend payers. And the active portfolio manager simply writes covered calls tactically on individual companies that allow you to harvest option income. So you really have 3 sources of return. You have price appreciation, hopefully, you have dividend income, and then you have option income. That really helps you really combat some of the volatility that we've seen in the S&P. And while the S&P is up about 1% this year, Devo's up about 3 times that, a little over 3%. So that's one way to kind of ride out this interesting headline-driven market.
And so where are your chips falling with regard to the U.S. exceptionalism versus rest of the world investment thesis?
Well, I think U.S. exceptionalism, is going to be kind of driven through Washington, and that's going to cause continued turbulence. And, because of that, we actually see more alpha opportunities outside the U.S., ex-U.S., in the international side. Those companies are generally cheaper. They have a kind of a different industry makeup than the U.S., maybe less tech heavy. And given all the potential tariff drama around technology and rare earth metals, we think that could be kind of a nice tilt to have this year. And indeed, international stocks have really been outperforming the U.S. So we think, many investors traditionally have said, I'm going to own international because I own the S&P 500 and 50% of their revenues come from outside the U.S. However, if you look at the S&P 500, relative to the international markets. We're seeing 12-15% difference in performance this year. You want to have dedicated international exposure. We offer our IDVO ETF that does that, and again integrates a covered call overlay there, and that's been up nearly double digits this year relative to, for example, the S&P. So we think having international exposure is going to be a big deal this year. It has been so far, and we think it'll continue through the end of the year.
You're also looking at a few different areas of the portfolio and perhaps even some of the defensive qualities that could transfer into an ETF play. How are you looking across commodities right now?
Yeah, so it's clear that hard assets, and we would call that gold, silver, and Bitcoin, are in demand with this fiscal deficit we're facing here in the U.S., as well as the potential large spending bill that it's about to be approved through Congress. We think that owning finite assets like these three areas we just mentioned, gold, silver, and Bitcoin, make a lot of sense. They can be volatile, but there's a lot of alpha there. Silver is kind of interesting because gold's really gathered all the headlines as a flight to safety trade. Silver has flight to safety aspects to it, but also has industrial demand that powers it. Silver's lagged gold this year, so we think silver could be due for a catch-up trade. Silver's still up 13% this year. We have a silver mining ETF that focuses on small and mid-cap mining stocks in the silver space. That's up over 31% year to date. That's SILJ. So, mining ETFs are really elevated in terms of their volatility. They tend to go up more than the commodity and then go down more than the commodity. So it's a double-edged sword. In this case, in a bull market for silver, we think SILJ is another great option for investors to be defensive and maybe get some alpha when it comes to hard assets.
You mentioned Bitcoin within that too. Why does Bitcoin fall within your hard asset category?
Yeah, well, there's only 21 million Bitcoin that'll ever be mined. 95% of Bitcoin that ever exists today, but less than 95% of people own Bitcoin. So there's a very interesting supply-demand imbalance. So we think because of that 21 million hard asset cap for Bitcoin, there is going to be kind of an intrinsic value placed on that. And with institutions now, whether that's governments and corporations starting to build Bitcoin reserves, we think that hard asset is something that investors should have exposure to. We have several products, whether it's a covered call ETFs like Biddy and Baggy, that actually own exposure to Bitcoin and then write covered calls to generate income somewhere between 24 to 30+% a year. That's one way to do it.
Yeah.
Another way to do it is own the equities that are related or highly correlated to Bitcoin. And we have the largest ETF going back to 2018 in that space, the ticker BLOK. So there's several ways to play Bitcoin, either through the equity area, the covered call area, or certainly owning a spot Bitcoin ETF from Bitwise or iShares.
Okay, my ears perked up a little bit when you said hard assets, then said Bitcoin, because I was like, wait a minute, it's not tangible, but I get the case that you're making for it here, at least within the investment thesis around it and the mindset. Christian, good to check back in with you.
Thanks, Brad. Take care.
Now time for some of today's trending tickers. We are watching Blueprint Medicines and Boeing. Joining me now, we've got my morning brief co-host, Madison Mills, here back on set. All right, let's set the stage for the folks at home, Maddie. First up, biopharma firm Blueprint Medicines is rallying after striking an agreement to be acquired by Sanofi for up to $9.5 billion here. Shares of Blueprint reacting just as you would expect for the company being acquired. They're up by about 26% right now, Maddie.
And what's really interesting is the price, $129 per share in cash, Sanofi to buy Blueprint for that amount. That's about 26% upside from where Blueprint closed on Friday. So a little bit expensive perhaps, and that might be why you're seeing such a rally in Blueprint, and then a little bit of pressure on Sanofi here, which is interesting given that there might be an indication that, it's potentially not the most well-priced deal. But of course, the big question is what this means for M&A more broadly rapidly here. This, of course, is a major deal, especially within the healthcare space that has been typically the defensive sector in the market, but not seen a ton of activity within healthcare over the course of this year here, and whether or not this kind of opens up a floodgate of additional M&A activity in the space, of course, is something that we're going to be continuing to monitor here. But as you can see right now, those Blueprint shares really soaring over the last 2 years. They're up nearly 120%.
We're going to be watching closely for that deal to close here. We'll track it. And also tracking here, shares of Boeing. Boeing upgraded to buy from neutral at Bank of America. The firm citing turnaround progress made under CEO Kelly Ortberg and Boeing's key role in recent trade negotiations. Take a look at shares of Boeing, ticker symbol BA. It's up by about 0.3% right now.
Yeah, they say the balance of issues tips into Boeing's favor here, especially when it comes to some of the trade policy challenges. They see progress in stabilizing production and carve-outs, alleviating any free cash flow burns going forward, and a renewed focus on performing in concert with the favored trade mechanism status, creating a buying opportunity for the stock here. And interesting to see them talking about how they've compared Boeing in the past to sort of having to create these Herculean efforts in order to restore it to American Titan status. But they say that narrative has changed thanks to new CEO Kelly Ortberg's appointment last August. So they really talk about Kelly Ortberg very positively here, saying that he has effectively approached significant challenges at the business, effectively managed through many labor issues at the company, and now focus is steadily on ramping up production, and they see that as feasible for Boeing going forward. Those shares up about 0.4%.
Maddie, thanks so much.
Thank you.
You can track the best and worst performing stocks of the session by scanning that QR code below on your screen. It was up a second ago. There it is. Back up. We'll give it a second. All right, now let's go to break. Coming up, we dive into the latest travel trends with the CEO of IHG Hotels and Resorts. That's next on Wealth. While macroeconomic uncertainty is weighing on consumer sentiment, data shows it isn't hurting most Americans' summer travel plans. Deloitte's latest report finds that 53% of respondents plan to take leisure vacations this summer, up from 48% in 2024. So we want to get the inside scoop, the real pulse of this business from Elie Maalouf, who is the CEO of IHG Hotels and Resorts. Great to have you here in studio. We know that the company is the parent behind these major brands like Intercontinental, Regent, and of course Holiday Inn and Kimpton, which I've had the opportunity to stay at a few times. Great properties there. Just take us into the pulse of what you're seeing among consumers right now amid this summer travel season that's just kicking off.
Well, thanks, Brad. It's great to be with you. The amazing thing about travel is, despite uncertainty around the world, you may have, trade tensions and some turbulence across many different sectors. Travel continues to grow. Mm-hmm. The predictions are for travel to increase domestically in the United States this year over the summer. UN Tourism just reported last week that international travel in Q1 of 2025 was up 5%. Over 2024. I mean, this is despite all the tension out there, 5% growth. Now, they may be going to different parts of the world, but people are moving, people are traveling. Business travel's back up. Groups and meetings travel's back up. The World Travel and Tourism Council reported that, last year was a record year for global travel and tourism. This year is going to be another record year. Uncertainty is the only thing we can be certain about. Yeah. Brad, is always going to be there, but people love to travel.
When you hear from customers who you're engaging with and their accommodations, which are a core part of their travel plans here, there's typically kind of two frames of mind that they're working through right now. And it's either, do I stay at one of the historic hotels, resorts that I've accumulated so many points at, or do I stay at a home listing type of opportunity, and how are you kind of communicating with customers the value add from the IHG perspective?
Look, we have 145 million members in IHG One Rewards now, up nearly 50% since 5 years ago. And it's growing double-digit a year. These are people that want to travel with IHG's 20 brands, 6,700 hotels around the world. Another 2,300 we have under development. Shared home rentals is a real business. Been around a long time. It used to be just, friends talking to friends or people looking in the newspaper and finding that shared home rental. So it's not a new business. It's just now on technologically advanced platforms and doing quite well. They're kind of different businesses. right? They've prospered over the last 10 years, and hotels have continued to prosper. So there is some concentric overlap in some places, but you go to London, you go to New York City, you go to Paris, you go to Miami, you go to Tokyo, hotels are busy, hotels are full, and share home rentals are doing well. It's really not competing in the same sphere.
For consumers right now, is this a consumer on aggregate that is trading down in their type of accommodation experience? How are they really being discretionary about some of those dollars that they're spending?
We get that question a lot because there's a lot of talk about, the consumer mindset, the consumer sentiment. There are two sort of hard to reconcile things going on right now. Consumer sentiment surveys, except for the one that came out last week in the US, have been down. Consumer spending has been up. Why? Unemployment is low, employment is strong, job reports continue to be strong, GDP continues to grow, bank balance sheets, corporate balance sheets, and residential home balance sheets are in good shape. Real wages are growing. So in general, the consumer behavior is actually much better than what they say their sentiment is, which is really what we want to see. And then when we look through our portfolio, we actually don't see the trade down. Yeah. We see our upper end, our luxury and ultra luxury doing very well. We see our everyday travel, Holiday Inn Express, Holiday Inn, Avid, Atwell doing very well. If you look at our first quarter revenue report that we put out at the end of the first quarter in April, what did we see? We saw 7% RevPAR growth in Intercontinental. We saw 3.5% RevPAR growth at Holiday Inn Express. Both ends doing pretty well.
And so when you think about some of the brands that our viewers see up on screen just a moment ago, if we could toss that back up, as you think through the pipeline that you have right now, and this is something that we hear from a lot of different hotel management firms and companies and accommodations businesses, is how many rooms they have in pipeline and adding to the capacity. What's that look like for IHG? And do you anticipate that you'll need to purchase other smaller players out there to add into that pipeline, or is that something that you view as having the cash, the capital right now to invest further in and home grow those?
That's a great question, Brad. Let's look at the fundamentals. Travel continues to grow for two main reasons. One, GDP grows around the world. Still projections for GDP growth for this year and beyond are 3 to 4%. The middle class continues to grow around the world. A little more east than the West, but it's still growing around the world. Those two propel travel around the world, the growth of GDP and the growth of middle class. Against that, we have 6,700 hotels open, another 2,300 under development. Just last year, we signed over 700 new hotels and we opened over 370 hotels. So where do we grow? We grow mostly by growing our existing brands. We got 20 brands, but once in a while we add a new brand. In the first quarter, we added Ruby, this premium, urban, lifestyle, really cool brand that's today just in Europe, 20 hotels open, another 10 in pipeline, but we're going to take it to the US and take it globally. Mostly we grow through our existing brands, we add to our new brands, but if you look at the upside, today, despite being 6,700 hotels, 80 years in the industry, we have only 4% of the global share of existing rooms. Only 4%. We have 10% of the pipeline. So we're consolidating growth into the future, but the headroom is very, very high. With only 4%, we got a lot of room to grow.
Just lastly, while we have you here, Ellie, I wonder, compared to non-tariff talk times in the past, are we seeing international travelers be a little bit more apprehensive to travel to certain parts of the world, knowing that their countries are in negotiation and there might be less favorability about how they are received when they go to certain regions of the world?
There was some of that at the beginning of the year. Okay. March was down in terms of European travel to the US, but April was up again. It's just amazing how people bounce up, go forward, keep traveling. Let's keep this in mind. First quarter international travel was up 5%. Over the first quarter of last year. People may be picking different destinations, but they're still traveling. And I just met with our top 60, 70 leaders around the world 2 weeks ago in Berlin. And they said, what about all this travel tension? What about this trade tension? What about all this uncertainty we're dealing with? I said, you're right, we got uncertainty. Look at our first quarter results. We still grew 3.3% RevPAR around the world. Right. But let's go back 2 years when we last met. What did you guys ask me about? You guys asked me about uncertainty. Sure. Inflation was high, interest rates were high, elections around the world, didn't know how the world was going to shape up. How did we do over the last 18 months? Very well, too. The only thing I'm certain about, Brad, is we'll always have uncertainty, but we also have growth.
And so lastly, I guess, are the bookings right now going forward looking more like the slump that you mentioned in March or the rebound that we saw in April?
Well, the figures I stated was inbound from Europe to the U.S. was up in April. It was down in March, but it shows you that there's a rebound. Now, domestic travel for the summer in the U.S. is looking up, according to the industry forecasters. We're pretty optimistic about the rest of the year.
Elliot, great to have you here in studio with us. Thanks for taking the time.
Great to be with you, Brad.
Coming up, we're sitting down with the CEO of a company with a bold and potentially risky option for retirement savings. That's next on Wealth. Experts recommend saving roughly 15% of your annual income in your 401k or IRA each year in order to save enough for retirement. But according to a recent LendEDU study, 53% of Americans are living paycheck to paycheck, leaving limited funds for retirement savings. Basic Capital wants to fill that gap with financing. The company, backed by Bill Ackman, is offering a 401k that matches each dollar contributed by a plan holder with $4 in financing. I'm joined in studio now by Abdul Al-Assad, who is the Basic Capital co-founder and CEO. Great to have you here with us in studio.
Thanks for having me.
So just break down how Basic Capital and the 401k plan works.
Of course. Our ethos at Basic Capital is that it takes money to make money. And in order to build wealth, you need to own financial assets. The problem that most Americans find themselves at is that they do not have the capital to buy the assets. So they're stuck in this chicken and egg problem. I had that problem myself when I started Basic Capital, and I wanted to build Basic Capital first and foremost for myself. When you have a cold start problem where you want to acquire something but you don't have the capital for it, we have built a solution for that as a society, and that solution is financing. When you want to buy a house, you finance the house with a mortgage. When you want to buy a car so you can drive to work, you finance the car with a car loan. When you are 18 years old and you want to go to college but do not have income yet, you take a student loan. And credit can be a really, really powerful tool. And our ethos at Basic Capital is to bring credit to financial assets which are diversified and compound and grow over time.
So you've compared this model to a mortgage, essentially. Why do you see this as similar to that?
Yeah. The mortgage unlocked home ownership for Americans. If you really look at the history of ownership in America, in many ways, it's extremely intertwined into the history of debt. If not for the mortgages, there would be no middle class wealth. 60% of middle class wealth is basically real estate. And if people could not mortgage their homes, they would never be able to buy it. But we believe that financial assets, stocks and bonds, are the new thing to own. Back in the days, you wanted to own land because we were agrarian society. You wanted to own homes because we were getting urbanized and people were moving into cities. But now, with AI taking over the world and automating so many jobs, that productivity gain is going to accrue to capital owners and shareholders. And the problem is that there is no real way for Americans to become capital owners and to become shareholders of our nation's wealth. And our radical proposal is you can finance it. Credit can be a really powerful tool. You should use credit to invest and to become an owner rather than to consume and spend.
So break down the fee structure for us. What does that look like?
Yeah, of course. So if you are a customer of Basic Capital is a 401k platform. You make recurring contributions. Every time you contribute to your 401k, you can choose to allocate into standard investment options or Basic Capital, the product. For every $1 you contribute to Basic Capital, we give you $4 of financing. This financing has a cost. The cost right now is 200 basis points over SOFR. In layman language, that's 6.25%.
Right.
That's much cheaper than mortgage rates. Mortgage rates this morning are at 7%. So you are able to access 5-to-1 financing, the same way with a mortgage, 20% down, 80% financing, at a much lower cost of capital. The underlying assets are a diversified portfolio of stocks and bonds. Okay. And as they compound and grow in value, you build wealth with a larger base of capital.
And so that also brings into question the time horizon, because you would have to hold that for an extended period of time to believe that, because not everything is just straight line up all the time. There are pullbacks, and so that means that there are some risks as well. What are some of those risks?
Of course. I get called in every day, or somebody every day sends me an article about a recession looming or something bad happening. And my hypothesis in this, I'm very, very much a Warren Buffett here. Nobody knows what the stock market is going to do. Nobody knows when is a recession coming. If anybody knew, they would not be talking about it on TV. The truth is, if you have a short time horizon, you want to stay away from investing. You want to go into high yield savings account, and you want to stay away from investing. But if you are investing, you should have a really long time horizon, and you should dollar cost average your contributions. That's just a really fancy way to say you should make equal contributions over your lifetime. What's the stock market going to do in a year or two? I do not know. I don't have the answer. But our proposal is, over the next 10, 20 years, if the stock market and financial assets behave like they did over the past 10 or 20 years, you're going to have a lot of value from having invested more money in the system. So in order for this product to work, you really need to have a long time horizon. And that's why we chose the 401k as an appropriate wrapper to deliver our financing to customers.
This is a unique model to save for retirement. It might not be for everyone. Who would this product work best for? And it really does come back to, I think, what you were mentioning with the long-term time horizon.
Time horizon. This product works best for people who have long time horizon, 10-year plus. Now, that doesn't necessarily mean it only works for young people. Because if you're life expectancy in the U.S. right now is 85 years old. So even if you are 60 years old and you have $1 million in retirement savings, that may not be enough to outlast you, right? That may not be enough. So you still have 25 years horizon, even though you're 60. So we see adoption rates all the way from people fresh out of college and 22 years old to all the way people who are already approaching retirement, but the way they think of basic capital as, this is my money for when I'm 70. This is my money when I'm 80, because the miracles of modern health is making us live longer, which is great, but it's also a real problem if you're not financially independent.
Abdul, thanks so much for taking the time here with us.
Thanks for having me. This was great.
Absolutely.
Appreciate it.
The federal government is expected to resume collections for Americans who have missed student payments starting early this month. That includes the seizure of some wages, tax refunds, and Social Security benefits. Here with more, we've got Yahoo Finance senior columnist Carrie Hannon. Carrie, what did we discover here?
Hi, Brad. Yes, back in April, the Department of Education announced that they were going to start, garnishing some of the defaulted loan sums from individuals. And this actually, for the past 5 years, it had been put on hold. And so they didn't have this, it was paused because of COVID, so they weren't doing these collections. But now they've announced they're going to start ramping this up again. And individuals who are going to get this started again, it will be taken from your Social Security benefit. This is specifically that group of people I'm talking to. And the Consumer Financial Protection Bureau estimates there are about 452,000 Social Security beneficiaries over the age of 62 who are currently in default on their student loans. And let me tell you quickly, default means that you missed payments for 270 days, and then they get turned over to the Department of Education for collections after 360 days. So this is the time frame we're talking about. What they're saying, Brad, is that they will garnish from the Social Security checks going out. The seniors will see smaller checks. They say 15% of the total amount before your Medicare payment is taken out. So that's out of the gross amount, 15%. They'll leave at least $750 in the checks. That's sort of the cutout, at least for now. And you got to figure the average Social Security payment today is around $1,523. So that's what we're talking about. There are things people can do if you're in the situation that they're going to start garnishing your Social Security check amounts to repay these defaulted loans. Now, again, you should have a 30-day notice, 30 days before they start doing this. But
Carrie, I think we were losing you for a second there with your audio. We're going to try and get you back a little bit later on. Thanks so much, Carrie, for breaking this down. Coming up, emergency savings strategies. We break down how much you should keep in case of emergency expenses. Stay tuned. School is about to be out for the summer, and many families are hitting the road and skies for vacation. The average cost of a trip in 2025 projected to be over $7,000, a 24% jump from 2024, according to insurance firm Square Mouth. So, If you're planning a family vacation in the near future, it's important to have a solid savings strategy. Here with more, Yahoo Finance personal finance editor for banking, Casey Bond. Casey, we got to know, is there any special way that people can save for family trips?
Well, some families might want to consider a vacation savings account. This is a special type of account that's offered by smaller banks and credit unions typically, and they incentivize people to save for the specific goal of a vacation. You can automate your contributions throughout the year, and then typically in the spring or fall, those funds are released and you can use them on expenses like hotels, flights, and things like that.
Okay, so that's the vacation savings account defined. What are some of the pros and cons of vacation savings accounts?
So the biggest benefit is that it really encourages account holders to focus on this specific goal. Often there are incentives like low fees or higher interest rates, and you really contribute toward the specific goal so that it doesn't get muddled with your other expenses or other savings goals. One of the biggest cons is that compared to maybe a traditional high yield savings account, the interest rates aren't as competitive, and you may have limited access to that money. You may not be able to pull it out without incurring a fee until you reach that specific date.
So what are the tips that you've been able to round up, the best ways that people can save the money for their next vacation?
Sure. Some things to consider: automating those contributions really helps. It helps you stay consistent. Taking advantage of credit card rewards. If you do use a credit card in addition to a savings account, sometimes those rewards can help you save a lot of money. Some banks also offer bonuses to new customers, so you may want to consider a bank that's also offering a sign-up bonus. And then as far as budgeting for this vacation, it really helps to calculate how much it's going to cost you in total, and then divide that by the number of months you have to save and kind of back out the math that way. And then you know exactly how much you should be saving on a consistent basis to ultimately hit your goal.
Casey, thanks so much.
Thank you.
Most experts recommend having an emergency fund to cover at least 3 to 6 months of expenses, but a Yahoo Finance Marist poll survey shows that a third of households could not cover 1 month's worth of bills if they lost their job or source of income. Here with more, we've got Pierre Habis, who is the head of Synchrony Bank. Pierre, great to have you here with us. A third of survey respondents couldn't cover 1 month of expenses. Is this, the 3 to 6 month emergency fund rule, something that you recommend?
Absolutely, and thank you for having me on. This is what every consumer needs to be doing in terms of preparing for what it could end up happening, these emergency funds. You just had a guest on talk about vacation and savings accounts. For me, it all starts with the habit of savings. So there's emergency funds, there's college funds, there's vacation funds, there's new car funds, but it all comes back to the same habits, savings. And what I would recommend for all your viewers, if you're one of those 33%, start with something very small. Sorry, it could be $10 a week, a month. It's all about habits, and then those habits then will build in time.
And so we continue to hear about those who might be living paycheck to paycheck as well. Some people may say that they don't have any extra to save in that case. Is there another strategy that folks can employ in this case?
So then it's all about trade-offs. And I can understand where consumers are out there are living paycheck to paycheck. Many of us, including myself, have been in that situation, and it becomes trade-offs at that point, whether it be where you go to eat, what you buy from the grocery store, whatever that may be. Maybe finding a different place to live, roommates, add one more roommate, whatever that is, find a way to do so. And if you're working for a company, I'll ask everybody, please look into your 401k plan that the company provides, if it does. And if it does, please take advantage of it.
So what are the steps to building an emergency fund?
So it all comes down first to the habit of saving. So you build by adding to that particular savings account, And you want to always have, and you had mentioned 3 to 6 months. You want to have a savings account that earns a high interest rate and that gives you access in case there is emergency. So I would always recommend a high yield savings account in that regard that gives you access, fully liquid. And then it's about doing automatic payments. You could do that from any checking account, generally at any institution, to a high yield savings bank in which you could build.
And so how do you maintain your emergency fund once you've actually built it?
Yeah, that's a great question, because you have the first recommendation is always keep it separate. Keep it separate from your checking account, please, because if it's linked to it or at the same institution, you'll find yourself, especially early in your savings years, that you'll use it and it may not necessarily be an emergency. So I would say first and foremost, separate it from the accounts. And in this way, you watch it build. And it will be motivating, especially when you start seeing interest on top of that.
Are there some emergency savings vehicles that are better than others? And what are the best ones?
Yeah. So it first starts with liquidity. Can you access it? And second, high interest rate. Those are the two things. Look for a bank that will offer you a high interest rate. If you that 3.5% to 4% right now with no minimum balance, and that you could access it at any time.
How do you go about, of course, the crucial decision of deciding, all right, this is an emergency versus, hey, things just are low on vibes right now, perhaps?
Yeah, I hear that a lot. This is the hard part. This is about self-discipline. So if you could get 3 to 6 months of your day-to-day expenses and put that away and just act like that's zero, that's zero. Now, I could guarantee you many of your viewers now will slip into use that, as you put it, for vibes or whatever the case is. As long as they recognize that and begin build savings again, sometimes you take 2 steps forward, 1 step back, 2 more steps forward, you're still ahead of the game. I just encourage everyone to do that habit. It's no different than exercise, eating healthy, and all that good stuff that goes.
Pierre, good to see you. Thanks so much for taking the time.
Appreciate it.
Coming up, we are halfway through 2025 almost. Tips to refresh your portfolio and what to discuss with your financial advisor. Stay tuned. It is graduation season with millions of American students entering into what could be a challenging job market. According to the New York Fed, in the first quarter, new grads had an unemployment rate of nearly 6% compared to just 4% for all workers. Here was some advice for the class of 2025. We've got Yahoo Finance senior columnist Carrie Hannon. Carrie, what do you recommend to new grads who are looking for work right now?
Oh, Brad, I absolutely love writing this column. So the first thing I would say is, when you're looking for jobs, think it's really competitive this year, more so than other years. So don't be discouraged. I mean, I really encourage people to cast a wide net. Look at all kinds of jobs that might suit your skills and your interests. Don't get locked into one lane, because this is the time to really cast that wide net to what that first job might be. And you want one that's going to build skills and that you're curious about and that sort of thing. So don't get so stuck on one thing. Second, build your network. Never forget that all those people you worked with in your internships and your classmates and your colleagues going forward, this is your secret sauce of power as you go through your career. So stay in touch with people. Develop those relationships. This is your network for life. So keep building it. Send notes, send cards, get together for coffee whenever possible. That's important. And invest in yourself. And what I mean by that is always be thinking about what skills can I keep adding? Yeah, I graduated from college, but keep adding skills. Keep raising your hand for workplace development programs or, any sort of activity you can do that sort of really shines up your skills, adding a certificate.
According to Deloitte, over half of Gen Z says that they value meaningful work. How can young workers find meaning in perhaps an entry-level position or just getting started?
Yeah, it's so true. We all do better work when we love what we're doing, right? So the first thing I say is dream a little bit. When you start looking at potential jobs, think about the things that really that you value right from the get-go. What do you align with? What companies, that their missions, their products, their nonprofit, whatever it is, what speaks to you? And think about how that might work for you. Even hobbies that you have. If you love to sail or something, think about the skills associated with that. And those are things that give you clues to what kind of job might really turn you on. So that's dreaming a little bit. Number two, write a mission statement. Never too early to write that mission statement about what it is you want to do. And this changes over the course of your career, but it's 25 words or less. It's active language. You want to inspire this. You want to, develop this. Whatever it is what's going to be true to you. That sets your guardrail for the kind of job you're looking for. And in this category too, I say give back. Really think about getting out of your head and into the world. If you're frustrated by the job search, if you're feeling discouraged, go volunteer. Go do something for somebody else. It will make you feel better, and you never know who you might meet at that nonprofit that can help you make a connection to the next job. Hopefully you're using skills so that you're building your own skill set, and you might even find a job right there. You never know. But I do think it's important to kind of, back away from that computer and get out into the world, and that will really ignite your job search.
We got about 30 seconds left here. Financial considerations. What should new grads be thinking about?
Yeah, take control of your financial life. Do a budget. Get serious. How are you spending your money? Take a look at that. Definitely set aside enough money in your retirement if your employer offers you one to at least match what they're going to match for you. So, a certain percentage of your salary. Automate. Make sure these retirement savings, and think of it as saving for life. You're not saving for retirement necessarily. That seems too far away. And I think it's important to build your emergency account. Start small, but do that automatically once again. And finally, invest in doing things, in traveling and exploring the world. This is going to make you set a little travel budget aside, because this makes you a richer person, a more curious person, and someone I think is a better potential hire for many employers. They'll see that spark in you of your curiosity about the world.
Carrie, thanks so much. Appreciate it.
Thanks.
Back in January, Americans set their financial resolutions to do things like save more money, spend less, and pay down debt. So, to mark the halfway point of 2025, we want to do a mid-year check-in covering everything from credit cards to life changes to make sure that you're still on track to reach your financial goals by 2026. Today, we want to start with your investments. I'm going to bring in Ann Lester, who is the retirement expert, speaker, and author of Your Best Financial Life. Ann, good to have you here. You say it's important to be right risked. What is that, and why is that?
So right risking is everything. Risk is what you spend to get return. So if you don't have risk, you don't get return. The trick is to make sure you've got the right level of risk for the goal. So emergency savings, a hugely important thing to have. If you're saving for that emergency fund, just in case you have a job loss, an unexpected car repair, you don't want that in the stock market. You want that, as your prior guest said, in a liquid savings account, maybe getting 3.5%, 4% interest. If you're saving for retirement and you're in your 20s or 30s, that is 30 or 40 years away, and you should be mostly in equities, despite the kind of roller coaster ride that you might have been experiencing over the last 6 months. So right risking means getting the right level of risk for the time horizon, how long you can leave your money alone without needing to tap into it. And secondarily, your own risk tolerance. But again, if you've got 20, 30, 40 years, you should be mostly in equities.
How often do you recommend checking in on your investments per year?
Wow, that's such a great question. So some people find it motivating and helpful to check and watch that pile of money grow. Other people find that existentially terrifying, especially when the markets are bumping around. My advice is to check in once or twice a year and make sure you're rebalancing back to that risk target. I think your birthday is a great time to do it. I recommend staying away from year end because the markets are often a little bumpy and illiquid around year end. And also there's so much other stuff going on. You don't want to beat up on yourself with New Year's resolutions and all this other stuff if your portfolio is not where you want it. So do it once or twice a year. Your birthday is a great day, or pick another day that means something to you.
What should you be discussing with your financial advisor as well?
Well, I think this concept of right risking is a great place for a financial advisor to really help give some solid advice around that correct mix of stocks and bonds. Bonds are there to help anchor your portfolio to stop it from being so volatile and generally, but not always, move in the opposite direction as equities. So they're a great diversifier most of the time. Your financial advisor will probably have some great tips right now as to the kinds of things you can be looking at in your portfolio. Maybe it's international equities, maybe it's bonds, maybe it's cash that can help get you to the right risk level. And the second thing a financial advisor will do is review your spending, your budget, and your goals and help make sure you're staying on track with where your money is going so that you hit those goals that you've established with your advisor.
There's been some volatility in the past few months. Should you be taking that into consideration, and to what extent?
So this is where this concept of right risking comes into play. If you need your money in 3 years, if you've got all your money for your house down payment and you're hoping to buy a house in the next 3 years and you've got all of that in the stock market, that is not right risked. Like that money should be in a high yield savings account or maybe in a little bit of short-term bonds. It should not be in the stock market. So when you have volatility and you've got too much risk, that is when you should think about making some adjustments. But if you're at the right level of risk, that's when you should leave things alone, because over time, the market will come back. It goes up over time, not all the time. And so keeping your eye on that risk time kind of point that you've set out for yourself is really important. And again, that's where a financial advisor can add a lot of value and help you stay on track with that long-term focus if that's what your goal is.
Anne, thanks so much for the advice. Appreciate it.
Thank you for having me.
Let's do a final check of the markets as we're taking a look at the major averages here. During today's session, we have seen the NASDAQ composite get into positive territory. It's up by about 1/4%. S&P 500 flat, just barely to the downside. And then additionally, the Dow Jones Industrial Average, that is still in the red, fractionally as it may be, down by about 0.4%, 172 points in negative territory. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up 3 p.m. Eastern Time.